Today on Go Ahead Ask, what is a Delaware Statutory Trust and how can it help you with your 1031 exchange transaction? Let's unravel that mystery on Go Ahead Ask.
Building wealth in real estate? Let the Exeter Group take the mystery out of how it's done on Go Ahead Ask.
Welcome to Go Ahead Ask podcast by the Exeter Group, where we unravel the mystery of investment real estate to provide investors with better quality information so they can make better informed investment decisions. Today, your host will be myself, Bill Exeter, CEO of Exeter 1031 Exchange Services, and Lauren Speidel, Regional Manager of Exeter 1031 Exchange Services. Exeter 1031 Exchange is a qualified intermediary or accommodator and administers all types of 1031 exchanges in all 50 states. Also part of the family of companies is Exeter Trust Company. Exeter Trust Company serves as custodian for self-directed IRAs, as trustee for title holding trusts or land trusts, as escrow agent for specialty holding escrows, and as custodian for custody services. We always encourage questions and topics here at Go Ahead and Ask, so please send your topics, questions, or even if you want to appear on Go Ahead and Ask to ask@exeterco.com, or you can call us at area code 619-239-3091. Do you love Go Ahead Ask? If you do, like it, subscribe to it, and share with all your friends and family. Today, the podcast is entitled Unraveling the Mystery of Delaware Statutory Trust. Finding and identifying like-kind replacement property as part of a 1031 exchange, as you probably know, can be extremely difficult, especially in markets like we have today, where there's tight inventory, bidding wars, and multiple offers. Today on our podcast, we have a guest, Daniel Raupp, of co-founder and managing partner of Fortitude Investment Group.
Securities offered through Concord Investment Services, LLC, CIS, member FINRA SIPC. Advisory services offered through Concord Asset Management, LLC, CAM, an SEC-registered investment advisor. Insurance through Concord Insurance Agency, Inc., CIA, Fortitude Investment Group, LLC, is independent of CIS, CAM, and CIA, all of whom are independent of Exeter.
So Daniel, welcome to the podcast. We're so glad to have you on board.
Thank you, Bill. I appreciate it, and thank you for having me.
You're welcome. Tell us a little bit about your background and also the company, Fortitude Investment Group.
Sure, I appreciate it. So I am a co-founder and managing partner of Fortitude Investment Group and founder of 1031DST.com, where we really have a wealth of information online. I head up the company's investment practice with a particular focus on real estate private equity. We work with high net worth real estate owners across the country, helping them with tax efficient investment vehicles, whether that is a Delaware Statutory Trust or other types of investments that we offer here. I began my career at Nations Bank and Bank of America in Charlotte, North Carolina at the headquarters, and transitioned over a period of time in 1999 to getting involved with individual investment advisory work with high net worth investors.
Thank you so much, Dan. We're really looking forward to our conversation today. I just have a couple questions for you. We like to ask our guests questions that can connect you with our audience. So we'd love to hear about what you like to do for fun or something that you're passionate about.
So away from real estate and just doing deals, because I really just love doing deals. I like very solution based. I love coming up with creative opportunities to solve investment problems. Away from that, I like playing tennis. I enjoy playing tennis. That's the workout. I love skiing. I have 4 beautiful daughters and a lovely wife, and a house full of pets, different animals that they each love and adore, and that I've grown to love. I'm that guy that kind of plays keep them away from me, but really secretly I love the animals. So that's out of the bag.
I love that. Sounds like you have your hands full.
I do.
What would be some recommended books, podcasts, or movies that you would recommend for our listeners? Something that maybe you just can't stop thinking about or talking about.
The Power of Habit by Charles Duhigg. Appreciate that book. It's pretty amazing if you can get yourself into a proper routine. And I think you could speak to that across all industries, and or whatever you're trying to change in your life. Habits extremely powerful. So I would recommend that. My daughter just for Christmas bought me a book that's kind of a work-life balance book. It's Do Nothing, and that's by Celeste Headley. So Do Nothing by Celeste Headley is another one. I think it's important because you got to recharge your batteries. I'm sure Bill would agree when you're spearheading a business and you're just running after it, going after it at 1,000 miles an hour and trying to be trying to show strength for both your employees that are following you, your partners that are following you, and of course your clients as well. It's important to take a step back and spend time on the things that do give you that energy to drive the bus.
That's great. And it probably has a lot of benefit for our listeners who maybe have a 9 to 5 work at home schedule, but never are leaving work right now due to the current environment. It's definitely hard to break away.
Yeah. And right now, people in positions that were 9 to 5 are no longer, because there's a window into their world 24/7. Now I remember a time when the BlackBerry was introduced, and it's the first time that email ever came into my home. And I remember turning to my wife as soon as I set it up and had the email on my phone. I said, my life has just changed forever. And it's a benefit and a curse, because you can't, the amount of efficiency and the hours that you can get into working, awesome, great for productivity, but horrible for mental health if you don't learn to balance it and shut it off. You can't have 24/7 work at all times unless you can turn it off. I should say you can't have healthy work and life balance unless you can learn to put it aside a little bit.
Great comments. Who are some people we should chat with on future podcasts, or a topic that you believe would be beneficial to our listeners?
I think the disparity between the price of real estate and the price in which you can borrow money at is a pretty interesting environment we're in. A lot of people are paused to do a transaction because they know that there's a lot of turmoil in the economy. There's a lot of things going on globally, and they feel like real estate's at all-time highs. Stocks and bonds are at all-time highs. At some point, the bottom is going to fall out. They're looking and saying, but I'm never going to have access to such inexpensive money. So what do I do? Is there a margin? Is there a specific formula I should be using? So I think bringing an expert on evaluation, real estate evaluation, would be a great topic.
Now let's unravel the mystery of Delaware Statutory Trusts. So if you are a new listener, you may not understand the idea of like-kind property. When you're doing a 1031 exchange, you may hear the term like-kind exchanges, or is my property like-kind? And like-kind means that any type of real property qualifies for an exchange as long as you had the intent to hold that property for investment purposes. So what falls into like-kind, some very well-known pieces of real estate would be single-family home, multifamily, commercial office, industrial warehouse, vacant lots, even mineral and gas interest, air and water rights, but also Delaware Statutory Trusts. So if you could just comment on what is a Delaware Statutory Trust?
Thank you, Lauren. So a Delaware Statutory Trust, or also known as a DST, falls under IRC 2004-86, of those of you that like looking up the actual codes. And very easy to understand. It's an entity. It's a trust structure that has deeded ownership to institutional quality real estate that you are able to take the proceeds of your real estate transaction and purchase an undivided fractional interest of that trust structure. And therefore, whatever percentage interest you own of the trust, you own of the building that's held inside of that trust. Now, because they come in all shapes and sizes, there could be a 400-unit garden-style apartment complex held in one of these DSTs. There could be a couple 400 or a few 400-unit garden-style apartment complexes in the same state or different states. So you can have multiple assets in one DST. They also come as triple net lease properties. So your corner drugstores, large distribution centers. We're also seeing them in hospitality. There's been hotels, not lately because of the COVID environment, but there were hospitality deals. There's storage facilities. Really, you name it, it runs the gamut. Even mineral rights wind up in structures like this that qualify for 1031 exchange.
And when investors are talking to us, they often kind of are probably have never heard the term Delaware Statutory Trust before. And so one of the questions is, why should I buy one? And how would you respond to that when the client's kind of looking at that question?
Sure. Well, provided the client's an accredited investor, which to be an accredited investor, you have to have at least a $1 million net worth or earn at least $200,000 a year in the previous 2 years and a reasonable expectation you're going to make it in the same year. If you're joint, it's $300,000 for the previous 2 years and $300,000 for the current year you're in. Once you're qualified for the DST, some of the advantages to you might be it's a passive investment. So you're no longer an active landlord. So you get to retire from the things you don't like doing, the stresses of being a landlord. You've got a professional management team that you get to vet out. You get to look at how is their performance before you decide to invest in the vehicle. Each Delaware Statutory Trust is sold as a private placement and is accompanied with a private placement memorandum, which shares all of the risks and rewards in it. There's no such thing as a capital call in a DST. So once you invest in a DST, the sponsor, the multi-billion or trillion-dollar real estate company that built these products, and at Fortitude Investment Group, we are not a sponsor. We don't build these products. We work with every single company out there that builds the DSTs, and we hire 2 third-party companies to do the due diligence, rip the deals apart, and decide whether they're likely to work out the way that the sponsor is stating them to. And then once we get to see it, we run our own due diligence. And once we decide that it's within our risk parameters, we approve it and put it on our menu. But where I was going is the capital calls, if there is an unforeseen circumstance, there's a reserve account within a DST that covers, and what would be an unforeseen circumstance? It would be an insurance deductible, a hurricane hit. So they can't come back to you and ask you to pay to play or put up money to stay in the investment, which is an advantage. You also have pre-existing non-recourse debt inside of Delaware Statutory Trusts, which is advantageous for a couple of different types of clients. It could be for a client that has a mortgage that they need to replace, because keep in mind, when you do sell, you've got to replace both debt and equity. The entire sale price of the relinquished property needs to be replaced. So these have pre-existing debt, doesn't show up on your credit. You don't have to be underwritten for it, but you get the tax advantages of the debt. We can customize a portfolio. So because they come in all shapes and sizes, you're getting layers of diversification. You can have different investment companies you're invested in, different sectors of real estate, and different geographical locations. So something in Texas, something in Florida, something in Tennessee. It really is across the country. The DST provides liability protection. So sometimes it's overlap you may not need. We don't give tax advice or legal advice, but you may not need that LLC. So talk to your attorney about that. You can 1031 exchange out of a DST. So later on in the future, when you're looking to do another exchange, you get to swap out and do it again. And we can take all shapes and size transactions. So if you did $1 million transaction and you found a $900,000 replacement property, we can help you on the $100,000 remainder by buying a DST investment, because the minimums usually are $100,000.
This episode is sponsored by our sister company, Exeter Trust Company. Did you know that all individual retirement accounts are self-directed IRAs? It's because you choose where to put them. You choose whether to put your self-directed IRA at a bank or at a securities or brokerage firm or a life insurance company. So that makes it self-directed. But did you also know that all IRA custodians are not created equal? Most IRA custodians, like the banks, the securities firms, and the life insurance companies, limit you to publicly traded investments such as stocks and bonds and mutual funds. But some IRA custodians, like Exeter Trust Company, allow investors to invest their IRA funds in other alternative assets such as real estate. Investors can acquire real estate, mortgages, deeds of trust, or tax lien certificates inside the IRA as an investment inside the IRA. To learn more, call Exeter Trust Company at area code 307-222-8750 or visit them on the internet at exetertrustcompany.net.
Now let's expand upon Delaware Statutory Trusts. What would you say are the benefits of a Delaware Statutory Trust?
So, Lauren, one of the things we've already touched on is diversification. So diversification is key. I'm a firm believer it's not going to be the things that you and I don't know that are going to hurt us. It's going to be the things that we're 100% positive about and wind up being wrong. So that means, did we put all our eggs in that basket that we were so certain about, and then it winds up blowing up on us? So we really stress being able to spread out that risk. So having low minimums in these types of products gives you the availability to buy several different high quality assets. We really stress diversification, and then also there is a tremendous amount of due diligence that goes in to each one of these transactions. So you have the sponsor, the real estate company with a proven track record that digs into the deal, approves the deal, vets the property. We have a legal firm that rips the private placement memorandum apart, makes sure that things are fair. There's loads, there's costs on these investments. You want to make sure that these loads, that these hurdles that the sponsor or the piece of real estate has to overcome are attainable. Because if you start in the hole as an investor, it might be very, very difficult for you in the future to get a return of your principal or a return on your principal. So both are very important. There's a lot of tax efficiencies with these. For example, if you sold $1 million property, all cash, you had no debt to replace, and you invested it in a Delaware statutory trust that was 50% leveraged, you've now bought $2 million worth of real estate. So you've increased your cost basis using non-recourse debt, and now you get to depreciate more real estate against the income you're receiving off that DST portfolio. That's another potential advantage that you'd receive off levering up. Keep in mind, if next time around you're going to do another 1031 exchange, you now have to buy or replace at least $2 million worth of real estate. So it goes both ways. You have to know what you're getting into, which I think is the other advantage and benefit of DST investing is disclosure. I'm going to be attached to these investments with my clients for the entire life cycle of the investment, meaning from the day that they invest till the day they get out, which usually by prospectus is going to be anywhere from 5 to 10 years historically. They are illiquid products. You do not buy into a DST if you know you're going to want to get out early, okay? Not liquid. You want to buy into it with the intention of staying in it for the life cycle of the program, which probably bleeds me into your next question, Lauren. So I'm going to pause there.
And actually, I was going to kind of bring up or repeat a couple of things you mentioned that really help clients in our world. One is debt. A lot of times you get clients who are trying to sell, do a 1031 exchange, and maybe they're self-employed or retired, or they have no earned income or what have you, and they get in the middle of their 1031 exchange and find out they can't qualify for financing. And what you had mentioned is dead on, where they can go to the DST and not have to qualify for that financing. So that could really solve that problem when they find out they can't qualify. They can't actually do that with the DST. And then the other point you mentioned is a lot of times clients will find property they want, they buy it, and there's a little sliver of cash left. And historically, going way back, they'd have to recognize and pay tax on that. Where today they can at least take whatever's left and, like you said, buy into a DST, and now it's all tax deferred. So that's fantastic. So we've talked about kind of the benefits. Perhaps you can touch upon what some of the disadvantages are of the Delaware Statutory Trust.
So Bill, some of the potential risks of DSTs that you're going to see, and I want to reiterate, is illiquidity. So an investor going into a DST has to go into it with the intention of staying in it for the life cycle of the program, which by prospectus is usually somewhere between 5 to 10 years. You don't want to go into this thinking that you're going to be pulling cash out of it early. They do sometimes sell early. If a deal comes in, an offer comes in that's too good to be true, the sponsor will likely accept that offer if they can hit their goals early and get a return, a capital gain back to investors, that the investor at that point would have the option, a 1031 exchange, and defer that gain again, or pay the taxes at that time. But just want to stress, you do not want to get into a Delaware Statutory Trust with the intention of selling out early. If you did have a unique situation and you needed to get out early, some or all of your interest in the DST, you'd contact the sponsor. We could help you with that, and they would see what they can do, but there's no guarantees of getting out of that investment. You do not have control of the investment. It's truly a passive investment. You have all of the same risks as direct real estate investing: declining market values, loss of potential income. You have to be an accredited investor to participate and purchase a DST. So you have, again, just to go into it, if you have a declining real estate market, the investment has the potential of loss of principal. What you're going into with the comfort of is that you've got a proven sponsor that has a track record, that has relationships, and they could potentially weather a storm better than your individual investment. And then by spreading the risk, you set yourself up for a little bit more, a little less risk by using that diversification strategy that we stressed on earlier. And then the other risk that I do want to highlight on again is if you do take on more debt. So if you increase, which is a strategy many people are using right now for a couple different reasons. One reason is there's been a lot of talk of the threat of loss of 1031 exchange, which I'm sure is another podcast, Bill, you work on as well. So people are going out there and they're trying to buy up. So this way they have more depreciable real estate. God forbid that we did lose 1031 exchange. They have at least tax shelter unless we lose depreciation too, which then we'll have plenty more to talk about, Bill, because we're going to have a lot more time. But I think I've covered majority of the risks there.
And I think something that wasn't discussed earlier regarding advantages, I know just from our side, being a QI, there's definitely times where people call and they're concerned about finding that replacement property on time. You've got 45 days to identify. Day 40, we might get a phone call from someone saying, I'm not finding anything, but I need to do this exchange. A DST can be a great option for someone because, Dan, as you know, you've probably got a lot on your shelf that you can review with these investors. And all the due diligence has already been done. So a lot of that has already been taken care of.
That's right. It's a prepackaged product. And at any given time, we get a phone call on the 45th day, and we're able to put together an illustration and a portfolio of qualified Delaware statutory trusts that not only can we get you to the identification level quickly, but we can get the money to work quickly too. So if you have a larger exchange and you're nervous about not having that money work for you, prior to you even closing on your sale, we can pick out the Delaware statutory trusts and have your money invested within a few days.
For some people who are still building their portfolio, the loss of control is very difficult for them to accept. A lot of times we see older clients that have already built their portfolio go into DSTs because they don't want to manage real estate anymore. Maybe they don't qualify for that loan like we mentioned earlier. So there definitely is a typical client that you probably see and that you probably work with. So we'd love to just find out what that typical client typically looks like for Fortitude.
Yeah, thank you, Lauren. So we really come across two different groups of clients that we work with. The first group is a family that's had an asset for a very long period of time. It represents a large portion, if not all, of their net worth. They can't afford to pay the taxes, and they certainly can't afford to lose the principal. So they're looking for tax deferral and preservation of capital within the risk tolerance of buying a DST, because just by it being a private placement, it's deemed a speculative investment. The other group of investors, which oddly enough have very, very similar risk profiles, are the extremely high net worth clients. These clients don't necessarily need to make any more money. They hate paying taxes and they hate losing principal. So we made a cognizant decision years ago to really only look to approve both partners or sponsors, as well as product that we think is highly likely to work out the way that the sponsor is marketing it. And that's why we take due diligence so seriously. In an environment that we're going to be attached to these products with the client for such a long period of time, we want to make sure our clients are happy and we're not getting hit with surprises. Now, that doesn't mean that there's not risks. As I said in the last question of some potential risks, there are risks of getting involved. We're trying to mitigate those risks so that we're trying to minimize those risks for investors to be able to retire and get some passive income.
Great. Thank you so much. And actually, Daniel and Bill are presenting on a webinar on unraveling the mystery of 1031 exchanges. You can register for that webinar by going to www.exeter1031.com and go to our seminar page. And there you'll find the link to register for that event.
As Lauren was talking there, I had a couple of follow-up questions I thought of. One is kind of a takeoff from what you had already said about kind of using the DST as a backup identification property for the 1031 exchange. What we find a lot of times too is realtors will call and say, I've got a client who wants to sell their current property, but they're not willing to list it. They're not willing to do the deal until they know what to buy, and we can't seem to find replacement property. So for the realtors out there, this could be a great solution to help them kind of facilitate that transaction and give the client some assurances that there'll be something there to buy when they're in their 45-day period.
I often speak at real estate schools trying to educate the realtors and give them a new tool in the toolbox. And that's what we at Fortitude Investment Group and our 1031dst.com website was built for. It's a tool, it's an educational tool to allow you to go in, learn about a different asset class that will help you get listings. As a realtor, you might be courting a prospective client, someone that you're looking to sell their property for them, and they're asking you, well, what are you going to bring me besides somebody else's headaches? It's a lateral movement. I'm not going to make any more money, but I'm going to walk away from the headaches that I do know for these brand new headaches that I'm not aware of. So why would I do that? Well, now you can partner up with us and let us come in, present a passive portfolio of 1031 exchange eligible investments that client now can say, wow, life after landlord. I can sell my real estate. I can retire, receive passive income. This is what I've been looking at. And if you're not learning this and if you're not bringing it to your clients, someone else is. So you're potentially going to lose a client that you've had even for a long time because somebody has taken the time to educate themselves on this asset class. So thanks for pointing that out, Bill.
Sure. It's always about or boiling down to, being a trusted advisor and really doing what's right for the client. And if the client wants to get out of property management headaches or what have you, that's the perfect way to do it. I love your term, life after landlord. I can relate to that.
and that's a great point you bring up, because at the end of the day, we're not looking to push product. DSTs aren't for everybody. It's not for, as Lauren said, the active investor still growing, trying to build. Although sometimes they want to cycle out of a time frame because they can't find anything quality. So they say, you know what, in the next 5 to 10 years, better than paying taxes, I'll roll into a DST portfolio, and then I'll regroup and decide if I want to go back to direct ownership later. But point being, we're going to know in conversation with investors before they invest if it's the right product, because I truly do not want clients invested in these products that shouldn't be. We have a great business, a great practice, and we don't need everybody to be our client. We just need the ones that potentially are good clients or good matches for the DST to be made aware of the DST. So thank you guys for this opportunity and the platform to talk about this.
Absolutely. Well, thank you so much for being on the podcast, Steve. We really appreciate it. This is good information for the investor who's really looking for info on the DST. So thank you for listening to the Go Ahead podcast today. Our next episode is going to be entitled Unraveling the Mystery of Title Holding Trust or Land Trusts. Again, if you like our podcast or love our podcast, please like it, subscribe to it, and share it. We always encourage questions as well. So if you have questions or topics you want us to address, email us at ask@exeterco.com or give us a call at 619-239-3091. You can find us on YouTube under Go Ahead Ask by Exeter. And Daniel, look forward to doing the webinar in a couple of weeks with you. That's going to be a lot of good information for clients as well. So those clients who want more detailed information, go ahead and go to our website that Lauren mentioned and register for the webinar. We'll see you all there. Thank you so much.
Thank you, Bill.
This is for informational purposes only, does not constitute as individual investment advice, and should not be relied upon as tax or legal advice. Please consult the appropriate professional regarding your individual circumstance. Because investor situations and objectives vary, this information is not intended to indicate suitability for any individual investor. There are material risks associated with investing in DST properties and real estate securities, including liquidity, tenant vacancies, general market conditions and competition, lack of operating history, interest rate risks, the risks of new supply coming to market and softening rental rates, general risks of owning or operating commercial and multifamily properties, short-term leases associated with multifamily properties, financing risks, potential adverse tax consequences, general economic risks, development risks, long holding periods, and potential loss of the entire investment principal. Potential cash flows, returns, appreciation are not guaranteed and could be lower than anticipated. Diversification does not guarantee a profit or protect against a loss in a declining market. It is a method used to help manage investment risk. Although an alternative product sponsor seeks to meet their offering objectives, there is no guarantee they will be met. Past performance is not a guarantee of future results. Institutional grade, high quality properties generally refers to a property of sufficient size and stature to merit attention from large national or international investors, and typically have the characteristic of high quality assets in major markets and at price points beyond the reach of individual investors and smaller partnerships.
Thank you for listening to Go Ahead Ask with the Exeter Group. Join us for our next episode when we further unravel the mysteries of real estate.